If you are over 50 and seriously thinking about your retirement, you should be aware of the pluses and minuses of converting your traditional IRA into a Roth IRA. In this video, I will share with you some of the costly mistakes that could be made that could save you thousands of dollars. Hi, my name is Mark Singer, and if you're interested in getting timely and up-to-date information about how to maximize your retirement income, click on the link below to subscribe to our channel and click the notifications bell to be alerted to when we post new videos. So let's get started, and let's start with, what is a Roth IRA? In all IRAs, you are able to have the monies grow tax-deferred and not pay any money. But the big difference is, once you start to take money out of a traditional IRA, the money is fully taxed. Whereas in a Roth IRA, the money comes out, assuming it stayed there for at least 5 years, and it comes out tax-free. Another very big distinction is when you reach age 72, now the new required minimum distribution age, whether you need money or not, coming out of a traditional IRA, you must start to take out approximately 3.5% of the value of that traditional IRA, and you will be taxed on all that money again if you need it or not. With a Roth IRA, there is no required minimum distribution. So depending upon the planning, the Roth may be very beneficial for you later in life. So the second question is, why is it so appealing, the Roth IRA, to retirees? The answer is you really have more control over the distribution of that money. Again, for many of my clients, whether they need it or not, they must take the money out at required minimum distribution age, which we know was just moved from 70.5 to 72. And if you have a $1 million IRA, you must take out somewhere in the vicinity of $35,000 to $38,000 for the year, and all of that money is taxed at your tax bracket. If you don't need that money, and that money was in a Roth, let's say, then you wouldn't have been forced to take that money out. Sounds like a pretty good deal, doesn't it? However, we have to understand what the catch is. Nothing comes free. We know that. So let's take a look at, let's say we're in our early 50s. We have a $100,000 traditional IRA that we recognize could be quite beneficial later on if we convert it now. So here's the catch. If you're rolling from or converting from a traditional IRA to a Roth, that $100,000, you have to pay taxes up front. Let's say it costs you $28,000 because you now have to declare that whole $100,000 as income above and beyond what the income is that you're already earning. So now you're moving it from the traditional IRA to the Roth IRA. For many people, most of their assets are in their retirement plan or in their IRA. So how are you coming up with that $28,000 to pay the taxes? Oftentimes the answer is there's not enough liquidity or cash flow sitting around, so you may actually have to take the money out of the IRA or the one that is still left over or the one out of the retirement plan. And so to take the $28,000 out to pay the taxes for the conversion, you're going to pay taxes on the $28,000 that came out, plus you're going to have another 10% penalty because you took it out before age 59.5. So unless you have cash sitting around to pay for the tax burden up front of converting that traditional IRA to the Roth IRA, it may not make sense, no matter how good it looks later on in your retirement, because it could be a very costly adventure now. Now, there are calculators out there to understand what's the break-even point for that conversion. In other words, if you took $100,000 and moved it to the Roth IRA, but really you netted out, because you had to pay $28,000, you only netted out $72,000, right? What's the break-even point? So if you did it at age 55 and you assumed a 7% return, how many years would it take for you to break even and be in the plus again? The only problem with that, and you can do that, go through that exercise, but the calculators basically say that you're going to earn 7% every single year. Does the market earn the same amount every year? Isn't it one year it's up 12% or 22% or 6%, and another year it's down 14% or 4%? It's never a straight linear line. So I don't put a lot of credence in those conversion calculators. And to be honest with you, for most of my clients, I don't believe that the Roth conversion is a good strategy to pursue in your 50s. However, if you have retired and you're now in your 60s or 70s or even later, and you have enough of an estate and enough liquidity that you are all set, then you may want to look at utilizing a Roth IRA for estate planning purposes and carving out a piece of the overall portfolio for your heirs. That is where I see the greatest benefit for the conversion to the Roth IRA. So the answer is, for those who are over 50, converting to a Roth IRA may not make a lot of sense. But I will tell you this, and it's a lesson we should share with our kids. The Roth is a great tool, particularly if we start really early. We can contribute to the Roth. You'll have to check with your accountant in terms of exactly what the contribution limits are and when you can and cannot. But the earlier we can contribute to the Roth, the more we can take little pieces of contributions and have them grow tax deferred so they become larger assets when we do retire, and then have more control over that money during our retirement years. So that's the answer to whether or not the Roth conversion is good for you, whether or not you're over 50 and looking to plan for retirement. This can all be very confusing, I understand. So if you're interested in learning more about how to take control of your retirement and how to maximize your retirement income, click on the link below for more information. And if you've enjoyed this video, please tell a friend, subscribe to the channel, hit the notifications bell below. Thank you very much for watching, and I truly do hope you enjoy the retirement journey.